So we're currently in a market correction, but I guess the bigger question is, are we going to go into a bear market where we dip below 20%, 30%, 40% and beyond? Now, we're in a really interesting time right now because Tesla reported their earnings yesterday and they beat earnings by I think like 50 cents or so per share. Now, that doesn't make them any less overvalued than they already are, but the thing is, they reported poor growth for the rest of the year due to supply chain concerns. This sent the stock tanking a little bit. I think it's down 7% right now. So this is the kind of market condition we're in, where even good earnings aren't rewarded. What else happened recently? Well, Powell came out last night and said that we are in a strong economy and that is why he feels like it is okay to raise interest rates.
Strong growth, a really strong economy.
While I agree that interest rates need to be raised ASAP, I think it is hilarious that he is claiming that we are in a strong economy. If you look back at 2021, USA's trade deficit is close to $1 trillion. So basically the amount of goods they import versus the ones that they actually make at home is minus $1 trillion. So that was my quick little catch up. But now I want to get to the real question of, are we going lower? Now, I want to ignore all this overvaluation stuff, the inflation, all the obvious supply chain issues, all these obvious problems that we have. And instead, I want to focus on something really technical that has predicted every single market crash since the beginning. So get excited. Hello, my name is Vadim, and if you haven't guessed yet, I'm really pessimistic about the market in every single sense of the word. And primarily, I guess, it's because I listen to Peter Schiff. He is a huge bear. He's against Bitcoin. He loves gold. This guy's really negative. Some things I agree with, some things I disagree with. But there's one thing that it all leads back to. And take a wild guess what that is. And it kind of goes like...
Printing. You know, we haven't been innovating our way out of crises. We've been printing our way out.
Along with Peter Schiff, I've been reading a book by Dalio. It only came out recently. It's called The Changing World Order, and it basically examines the cyclical rise and fall of major world nations and their currencies. Now, in a nutshell, the typical pattern that he presents in the book looks something like this. Now, once again, along with the many trillions of dollars that the Fed has printed in the last 2 years, inflation on the rise, and America producing less and less of their own goods, you can make an educated guess that we are somewhere on the tippy top of this very chart. There has been a recent development that has pushed me to a more logical approach as to why we might be going lower, and this specific indicator has predicted every single market crash since the beginning, and I think it's just best if I show you right here. So this indicator is the yield curve. Now, the yield curve shows the relationship between long-term and short-term interest rates of US bonds. Essentially, bonds are money that you lend to the US government. So as an investor, you take on more risk by letting the government keep your money for a longer period of time. Now, naturally, you're going to want a higher interest rate to compensate for your risk, and that's pretty normal. So the thing to note is that these long-term bonds, a few things that affect their future interest rate. One of them being investor demand, and while it's not the only thing that controls it, it's a pretty significant portion of it. So if you think about it, long-term bond interest rates reflect a public's trust in the government to basically pay you back in a way bigger, longer time horizon. Now, sometimes when the short-term interest rates equal the long-term interest rates, we have a flattened yield curve, just flat. Now, the moment that you want to get concerned is when the short-term interest rate climbs higher than the long-term interest rate. So the curve is an inverted yield curve. Now, this is exactly what happened in August 2019. So let's do a quick flashback.
Waking up this morning to a recession warning from the bond markets.
The Dow plunging more than 800 points, sparked by a key economic indicator faltering.
A brutal day on Wall Street, stocks plunging as the yield curve inverted, sparking fears that a recession could be on its way.
So the yield curve inverted. Where's the crash? What's going on? Well, I guess that's why you should worry. So let's pay attention to this chart here. This chart represents the difference between these long-term 10-year treasury interest rates and the short-term interest rates. Now, every time the chart dips below zero, this represents an inversion because the difference between the two interest rates goes below zero. Now, it's what follows this inversion that we should fear, because you can notice here that every area in red represents a bear market. And note that it happens shortly after that yield curve inversion, not immediately. So you have time to basically see this yield curve invert, and then the market begins that crash. Now let me show you an up-to-date chart that shows where we are in January of this year, 2022. Now it takes a quick glance to realize the distance or the time between each yield curve inversion and the following market crash seems to show us that our time is coming very, very soon. Now this is where the story gets a little bit scarier. I found the exact times between a yield curve inversion and the following market crash. So the last yield inversion we had, as we saw, was in August of 2019, and it has now been 29 months since then. Looking back at these different time frames, the largest time span was 33 months, and this was prior to the dot-com bubble. Now, since this is basically a bubble too, you have every reason to speculate that it might also be around this same time frame. So let's just take a moment to take that in. More than 90% of the time, when we have that yield curve falling about 20 to 33 months, we have our market crash. And now for us, it has been 29 months since our last yield curve inversion. So knowing this information, what should you do now? Well, I'm personally going to start buying a smaller and smaller portion of ETFs every single week, not like my usual. Just go a little bit smaller just in case we do have that dip. I'm going to have more and more cash accumulated to buy in if we do have that bigger, deeper downturn, which I personally am expecting. But like I said, it is speculation and it's based on my broader frame of mind. And I guess it's also to do with this little chart here. That's my take. Let me know what you think. If you wish to find out more about the yield curve, I'll link the videos that I use, the charts that I use, and yeah, thanks for listening.